Hello, welcome again to Analyst Insights. We are glad to be hosting this show for you. And today we are joined by special guests. In the studio today, we have got the Managing Director for Mashonaland Holdings, Gibson Mapfidza, and the Chief Finance Officer for Mashonaland Holdings, Kuda Musundire. Welcome, gents.
Thank you.
And as usual, I am with my colleague Rufaro, so we're going to have a discussion, nothing very serious, but just to get a sense of how Mashonaland performed in the last 12 months. Welcome, Rufaro.
Cheers, thanks for having me.
Good. So we were just having a discussion just before the show went on air about how can you help the investor and the analyst to make sense of the numbers in the way that you understand them. So maybe Gibson, you get us started by just giving us a picture of what you saw in 2022, and then Kuda, you speak to how that then translated into the numbers that we have. How was 22 for Mashonaland Holdings in terms of performance and everything?
Okay, thank you very much, Ranga. I will leave the earlier discussion to Kuda in terms of making sense of our financial statements in light of hyperinflation and the adjustments. For us, 2022 was a year to recover the 2 years we lost due to COVID. So our thrust was to make sure that our existing portfolio performs mainly in terms of occupancy levels and also in terms of ensuring that we collect rentals. 2020, 2021, we were a bit lenient on our tenants in terms of rent payments because the environment was very difficult, especially for the office users, because working from home and also the restrictions were very high. So indeed, when you look at our metrics in terms of occupancy levels, we moved from 81% to 87%. When you look at collections as well, we closed the year at 92%, which is 2 percentage points down from 94%. Also, in terms of our projects, we wanted to make sure that we move ahead with those projects. As the market may recall, our key strategy from 2018 was diversification because of the concentration in the CBD. We had already started some of our projects during COVID, but the pace was not as planned because of the restrictions and a lot of other issues to do with COVID as well. But 2022 saw us significantly progressing, especially with our cluster housing development in Westgate. I think at close of year, we were around 76% completion. We're targeting to finish that project during the second quarter. We also commenced last year our day hospital in Newton Park. So again, the thrust for last year was to try and recover the lost ground in terms of projects and also optimizing the performance of our project, of our portfolio. Could I talk more to how those efforts translated into numbers in terms of our revenue growth, our profitability, and also the growth of our portfolio at large as well?
Yeah, maybe you can dive straight into the numbers and then we could have some follow-up discussions on the strategy and all.
Okay, thank you for that, Aranga. Indeed, you are correct. A lot of analysts and a lot of people in the investing public struggle to understand inflation-adjusted numbers because of the way that they are prepared. Not a very easy standard to follow.
Okay.
In fact, in the accounting world, we joke that it is Zimbabwe and only one other country that are currently following this. So it's
which other countries?
I think it's Venezuela.
We are in good company.
I almost took a guess.
Yeah.
Okay.
So it's indeed a standard that's difficult to understand, but nonetheless, the whole process that's applied in inflation accounting is to try to make numbers measurable in today's value of money. So that same approach is applied to comparative results. So going straight into the numbers, our revenue was 98% higher than what we recorded last year. So when we say 98% higher, the immediate reaction for most is to say that's driven by inflation. But what we've done is to even out inflation. So that growth is, you could call it real growth in Zimbabwe dollar terms. But also contributing to that performance was one of the cluster housing projects that we concluded. We concluded a major part of that project. Marshview Gardens project, which is in Bluffview.
Okay.
It's a cluster housing development that we have. We made a lot of progress in terms of developing that project. So 30% of our revenue came from there. We earned it from there. The project is coming through, and its revenue is only earned in US dollars.
Okay.
To give maybe further insight to what the revenue performance means, when we say we posted a revenue of 3.8 billion, in there is 3.8 million that we raised in US dollars.
Okay.
So part of our revenue from our operating activities, we raised 3.8 million.
Okay.
We also did raise additional financing from disposal of our non-core investment properties, which Kitty we are utilizing in the current year as we look forward in developing our strategy of diversifying our portfolio. Ratios, I guess, at the end of the day, also tell a complete story. When we analyze what our ratios, how they compare with what we had last year.
Okay.
We closed the year with an operating profit margin of 93%, which is higher than 57% that we had in the previous year. But partly also bolstering that performance were profits that we made in US dollars from disposing some of our investment properties that we had classified as non-core. Here we're speaking about Charterhouse. You may know about the transaction that we made on Charterhouse. And also a land bank that we identified as non-core to our operations in Harare. So these were disposals that came through and earned us money in US dollars.
So, okay, so when you look at those numbers, maybe as an analyst, I would ask, how sustainable are they? So is it something that you think is the kind of level that the business is going to be operating at? Or, okay, you've alluded to the fact that there was a disposal, so obviously it's a once-off thing. But when you look at the margins and all, the 98% you are alluding to, it doesn't sound sustainable. What kind of levels do you think the business would be operating at, so that at least we are better informed when we're looking at these numbers and then try to gauge what will happen into the future?
Okay, thank you for that. So if we're to analyze what's been happening with our operating profits, operating profit margins over the last 5 years, they have been gradually coming off as a result of not only the cost of maintaining properties, but in some instances, some of our properties also aging.
Okay.
So it's speaking to our strategy where we are seeking to revitalize our property portfolio. So whilst we may not hit the margins of 93% only from operations, we expect to be closer to the 60% range, which is slightly higher than the 57% in thereabout that we've been recording in previous years. So yes, there will be a bit of tapping, but that will be supported by new developments. We'll be able to see an increase in the volume of operating profits coming from the developments that we've got earmarked. I think Gibson will speak to the developments pipeline that we have. It is our intention to continue participating in the residential space by developing and making available housing developments that speak to our housing needs as a nation.
Maybe before Gibson chimes in, so if those, maybe one would say, given those fantastic numbers, what does it translate into cash flow wise and dividends? And I saw you declared the dividend. What's the policy? The cover which is there, is there any kind of progression that we should expect as a market? But surely, if you're posting fantastic numbers, the shareholder also has to participate in one form, in a way that is predictable. Or maybe you're the one who can actually, you should take this.
Interesting question. So when you look at us as a business, we are on a growth path.
Okay.
And yes, in as much as we have looked at our shareholders, engaged with them, we understand their dividend expectation. Our policy is 80%, which we think is very competitive. Kuda will talk more in terms of the complexion of money that we are also going to pay that dividend with. But we are very much focusing on retaining some of the profits,
Okay.
so that we can plow back into the business to achieve that growth. When you look at our model property portfolio that we want to achieve in the next 3 and 5 years, we think it speaks more to their needs in terms of cash flow, but also very much strategic in terms of the locations we want to go into, which talks to capital appreciation going forward. So I think it's a balancing act. We understand their needs. We know they have obligations, especially in terms of insurance. We feel 80% is very much competitive, but also trying to ensure that we use as much as impossible internal resources. I think we know that debt is cheaper than equity, to be honest. But when you talk of debt in Zimbabwe, that conversation can actually change in terms of the long-term debt that you're looking for, and also it being competitive, especially when you compare the cost of capital and compare to the returns you are finding in this market as well. So it really helps if we can use most of what we make to redeploy and also rebuild the portfolio.
Yeah, because right now the investor is quite sensitive. And you also have to know that as a property holding company, you are actually now competing with rates. So because the attraction on the rates is on the cash flows that are being paid on a regular basis. And these cash flows, the investors know well in advance.
Maybe for the benefit of the audience, you could just explain what a rate is and why they've become a little bit popular in this part of the world.
Okay.
Thanks, Rufaro. So there's a new asset class on our capital markets, which is the real estate investment trust, where the investors are actually investing directly into a fund that is owning properties, and the biggest benefit is the cash flows that are coming in terms of the rent coming from that pot or from that fund is actually distributed in a more regular and sort of predictable fashion. So they have to distribute as much as 80%. So you have got a portfolio that's collecting $100 maybe every 6 months. Whenever that $100 comes through, you have to pay out 80. And I think for a long-standing investor in Zimbabwe, that is more attractive because the story about growth opportunities tends to be very difficult. You know why? Because of the economic cycles that we are always that we are always encountering. That may make some of the projects that look good today to be to fail actually to yield the expected incomes. So you are a property holding company, and your number, the 80%, sounds very competitive. Have you been consistent in terms of how is there an obligation to stick to that number? Because if you do, then you are making yourself as competitive as the rates.
Exactly. So I'll come in first, then Kuda can come. I'm very happy that you have realized that the biggest advantage with rates is the regular and compelling distribution rate.
Yes.
So our 80% dividend policy is a policy.
Okay.
Which, in as much as management, we don't want to pay as much because we want to deploy, but it's a common policy informed, which is communicated, approved by the board, but also communicated to the shareholders.
Okay.
And we also pay dividend twice a year.
Okay.
So in a way, we try to mimic the REITs.
Okay.
When I look at the REITs, I think it's more for short-term, speculative, and the retail market. When you look at our shareholders, I think we have a fair portion of our shareholders who are looking long-term. And when they look at our strategy in terms of diversifying, going into new geographies, which we were not in, I think it talks to that long-term obligation that they're also holding. Okay. So yes, when you look at REITs, they really resolve, I think, 3 key issues about property within multi-asset investment portfolios. One of them is liquidity. They are more liquid as compared to maybe listed property shares. They also don't give a lot of burden on management, especially when you then compare direct property ownership by, say, insurance companies compared to REITs. You don't have the management element. Okay. But I still feel that in this market, there's room for listed property shares as a compelling investment, depending with your dividend policy and also how regular you pay that. Us even making a decision to pay a portion of our dividend in US dollars, could I talk to that, is also realizing that we have to compete with the REITs.
Okay.
and in a way try and deliver what REITs can deliver to the shareholders as well. But yes, there's a room maybe for us going forward to look at it and say, do we want to also play in that space as well?
Maybe you can talk about the color of money before Rufaro comes in. He's actually quite. He got me excited when he talks about the dividend. How much did you pay, and in what currency?
Thank you, Ranga. We are looking forward to distributing our final dividend in the next 2 weeks by the end of the month. I think our shareholders who have received. So our final dividend is split in 2 parts. We are settling a dividend of $200,000. This will be paid in US dollars. We are working with our transfer secretaries immediately to ensure that all our shareholders actually remit to us. There are no straw banking details because we want to pay it in US dollars.
All right.
So in total, if we were to translate everything that we have distributed, we are looking at ourselves having distributed a dividend of 370 million in total, coming from our 2022 results.
Okay, no, the 370 million sounds very confusing. The 200,000 that is straightforward.
Okay.
Rufaro,
Yeah. So I wanted to get your opinion on the valuation of the business because it's trading at a discount to the net asset value on the ZSE. So, and you'd actually expect it to trade at a premium because you're pricing in inflation at any given date. So why do you think that it's trading at a discount? And perhaps do you think, given that your 90% plus of your balance sheet is non-monetary, it's in land and buildings, is it not easier? Does it not make more sense for it to be valued in US dollars and for you to migrate to the Victoria Falls Stock Exchange, where you can report all your numbers in US dollars and your valuations in US dollars, and perhaps it'll be easier for the market to appreciate the value of the company?
Okay. No, thank you very much for that question. I think it gives us an opportunity to try and explain and also shed light. So property companies, listed property companies across the globe, even in America, they trade at a discount. In Zimbabwe, it is the level of discount that we have. So I'll explain the first trend to say generally property companies trade at a discount. Then I'll come to Zimbabwe and to MASH specifically. So the first point is there are 3 key reasons why property companies trade at a discount. The first one, which applies across, is the contingent liability on CGT, capital gains tax.
Yeah, sure.
When we sell all the properties, there's CGT liability that is embedded. Then secondly, it's a punishment for the illiquidity of the asset. So properties by their very nature illiquid in terms of when you transact, you incur a lot of cost, both buying and selling. So that trading at a discount takes that into account. Then the third one really is when you look at property as well in terms of its risk, embedded risk, there's a lot of risk as compared to equities. So this really cuts across the whole globe in terms of listed property shares. Ordinarily they trade at a discount. Sadly, when you check South Africa, I think we're looking at Growth Point with Kuda, and looking at comparing Growth Point and us, which is also a listed property company. You remember the discount they're trading at?
They've got a 52% discount.
52% discount. So I think in Zimbabwe, it's about the level of discount that we are trading at. A MASH Kuda told me we are trading at 74%.
Yes, 74% discount.
So that level is a concern even to us as well. When we look at it in terms of those 3 factors and say, what else is causing it in Zimbabwe? And I want to focus on MASH. When you look at our portfolio, it's been so much concentrated in the CBD, which in the 90s, coming early 2000s, it was a good thing. Because at some point, MASH used to perform. I think MASH was number 1 in the market, even managing their properties. I was a CBRE. We used to manage the properties, and everyone wanted to manage MASH on behalf of the landlord because it was easy to manage. They had very good tenants. ZB Life Towers, very good tenants. ETC Chairs House as well, ZB Center. But when you look at that concentration and talking to the economy now, there's a mismatch. And that's why we are trying to want to diversify. Diversification, reduce concentration in the CBD, move out where the market is looking for new opportunities. Not just Harare, but we are going to Rishawan, we're going to Bulawayo, we're going to Victoria Falls. So our thinking is after we've implemented our model property portfolio, that trading at discount should sort of mirror what is happening, say, in South Africa.
Okay. Yeah, but I hear you. But for a business, a property business, even in Zimbabwe, listed in Zim dollars, you'd expect it to trade at a premium, not to buck the global trend, but because all you're simply saying is, if you make a decision today to sell all the property in your portfolio, right, those sales are likely to be closed because of the nature of the transactions in at least 60 to 90 days. And if you're going to, and by the time you translate those transactions into Zim dollars, it will be a higher amount than the Zim dollar listing as of today. That's the nature of, so it's a currency. The Zim dollar valuation has to be, has to factor in that forward movement in between your balance sheet date or reporting date and when you actually realize close the transaction. So whereas if it was listed on the VFX in US dollars, then we would expect it to trade at a discount just like everybody else, and it's like, then we can have a debate or discussion about is this discount too much or too little given the jurisdiction. But for a Zim dollar price, you'd expect it to have a premium because of the inflation embedded in Zim dollars.
Okay, yeah. But I think, when we analyze the share price performance, there are a lot of other things that also influence the performance of our share price. You will remember the changes, I think the way fiscal changes that that really shook the stock market in the just ended year. And to some extent, you as analysts maybe can conclude better whether our stock market is effectively recovered from those changes that were implemented last year. If you look at our share price, so indeed we are trading at a discount. You look at the other property company, even the other top counters that we also have on the ZSE, non-property counters, they also trade at a discount. It's a function of not just the property sector on its own, but
it's market-wide.
It's
equity
market-wise.
market.
There are distortions on the equity market. But what it also says is that there is potential for for investors to actually make money on our counter. That's what it is.
And in terms of there's a debate ongoing about the future of our local capital markets, the ZSE versus the ZSE, whether it makes sense. I'm of the view that we're going to see an exodus from the ZSE to the Victoria Falls Stock Exchange, simply because the trading in US dollars is more sustainable. It makes more sense in a hyperinflationary environment. So I'm sure you and your board have been seized with this question. Do you see your future on the ZSE, or migration to VFX is something that you're going to?
Okay, that's a good question. I think it's a good question, and we get that question quite a lot. It's a question I think that is probably best answered by our shareholders. It is our intention to really solicit and get thinking around this, so that we can make a holistic decision. I think it's a decision that maybe is not just made by management or the board, but will involve our shareholders ultimately.
And just to add to that as well, so when you make that decision to go and trade on the VFX, I think you need to look at the composition of your revenue in terms of how much of it is it US dollar and how much of it is Zim dollars, so that you are able to then meet the obligations and expectations of listing on that market as well. Okay. So we are also monitoring. I think close of 2021, in terms of composition of our revenue, on 25%.
Yes.
We closed the year in terms of the rental portfolio. We closed the year at around 53%, just the rental portfolio.
Yep.
If you then add development, which Ranga says is sustainable, we won 71%.
Okay.
So I think as those numbers move up, and our thrust this year is to keep growing the US dollar revenue. As we do that as well, it then ticks that box to say maybe we should transfer from ZSE. But for now, very happy with ZSE, and I think it talks to the complexion of our revenue. So,
I want to ask something about the valuations. So there's the carrying amounts that you have on your balance sheet, and there's what is happening on the market. So given your experience with the charter house, how far were you from the carrying amount when you did this transaction? Was it done at a big discount? Or because there's always a debate in the market that maybe you guys, not you as much, but as property companies or everyone that owns some property in Zimbabwe, they tend to exaggerate, overvalue their property. But maybe the actual transaction taking place are probably of a figure much lower. What was the experience on the charter house?
Okay. I think before I come to Charterhouse, just to talk about
In
valuation in
general.
this country, yeah. So, valuation, it's really a science and an art to estimate the likely selling price, estimate of a property. So what the valuer is really doing, they're estimating to say if this property is going to sell today, how much is it going to sell at?
Okay.
And when you then look at our market, what are they using? They're using recent comparables.
Okay.
When you look backwards before Charterhouse sells to say, when was the last property high-rise building in the CBD sold? Maybe it's 5 years back.
Okay.
So that estimation process in Zimbabwe is very much distorted by lack of information, one, but by inflation as well.
Okay.
And also the current issues.
Okay.
So I should say the estimation, the quality of estimation of valuation in Zimbabwe in a hyperinflation environment, maybe Venezuela is facing the same challenge, is so much affected by the macroeconomic fundamentals. Inflation is one of them. So we're actually in an abnormal market. And the Royal Institute of Chartered Surveyors will then give you guidelines of valuing properties in that environment. I really think the valuers have very tried hard to do well. But when they look at transactions, so we did not only transact Charterhouse, we also sold properties. Our lived experience is that the carrying amounts were actually lower than the actual transacting price.
Oh, is that so?
There are many factors that comes into play. Some certain buyers, especially in this market, maybe when they buy, they offer at an emotional value because they have special interest to what they want to buy. So there are a lot of factors to account for that. But generally, our carrying amount.
Are you suggesting that government overpaid for Charterhouse because they were, because of its historical significance, they were excited about owning this asset?
I am suggesting that valuers are a bit more prudent and conservative when they are valuing for carrying amount purposes.
Okay, maybe let's talk about yields. So 6.5 weighted average yield, is that where you want to be? And one figure, in fact, when you look at sector by sector, the numbers sort of shocked me that the industrial properties actually have got a high yield, and then retail, the much lovely retail has got yield of 5. Maybe walk us through the whole yield scenario and whether it also has got the impact in terms of the valuations. Yeah, because a property, I think a part of valuing a property is its ability to generate some cash flows.
Okay, I'll come in first, then Kuda can really drill into the numbers. But you ask 6.5, is it where we want to be? No. So we're looking at northwards of 8%. Our benchmark, our target is 8% in this market. But assuming that a lot of the economic fundamentals improve, we actually think we want to go as far as around 12%. We already have specific properties within our portfolio delivering 12%. When you look at the weighted average, we already know we have certain properties pulling down those numbers as well. So our thrust going forward is to try and improve those yields. But when you look at improving yields, what are you saying? The denominator is given, is the numerator. You look at the tenants in terms of their rent-paying capacity. We are coming from COVID as well. And you have to choose to say, do I want occupancies or I want an empty building and I have to pay municipal rent on my own, water, electricity, etc. So I think it's really a balancing act, and you want to correct that yield over a longer period so that the whole business model is also sustainable.
Okay. All right. But what would be the break-even yield for, like, on an average basis? How much would a property company need for them to be able to pay their bills and everything?
Well, certainly I think you'd look at it on a property by property basis, look at where the property is located. Also important to look at the property's condition. because I think that plays a major part in determining that yield number. But certainly a number closer to 8%, I think would be more compelling, because the yield number has got to make sense versus your cost of capital. So this is exactly where we are going to as a company. If we look at the projects that we are embarking on, our intention is to go even slightly higher than that. Some of the projects, I think we have been able to successfully off-sell some space in some of the projects that we are doing, and we've been seeing yields north of 9%. So average comes to around 8%, but there is potential for us to correct that number even as the economy also improves. I think what Gibson spoke about with regards to us coming from COVID and us looking for a balance with regards to the rental number in the occupancy that we would want to see in the property. So the yield, yes, it slightly took a knock from what we had last year, but some of the companies that we also have in our books also recovering, I must say, from the effects of COVID in the previous year.
So, okay, Rafael, maybe
so,
last question.
One of the common themes across the big legacy property companies is that the CBD is in decline. So if you have a property in the CBD, it's not as exciting for business people to be based in the CBD, and there's this narrative of decline. And if you look at the region, the Johannesburg city centre also had the same challenge about more than a decade ago, where it was in decline. Everybody was moving to Sandton and these other places that were cooler and hipper. But there was an initiative led by some of the oldest businesses in South Africa, Anglo-American, Standard Bank, to rehabilitate the Johannesburg CBD. And it seems to have succeeded to some extent. It's got a new lease of life. It does make sense for a lot of people to do business there. It hasn't died like the doomsayers said it would. So, when you look at our CBD, yes, there's, Borrowdale and Arundel and all these other places where office parks have mushroomed. Do you, when you speak to your colleagues in the property sector and in business and industry, do you think it's possible for a revival and renewal of the Harare CBD, or perhaps, this one is going to die?
Okay, that's a very good question, mouthful as well, and the answer is very long. But let me try and summarize this. So cities or urban development, they go through a life cycle: growth, maturity, decay. At decay, you need to rejig, which is revival. So what is happening to the city of Harare is not starting from Harare. In fact, urban decay started in 1930 after Great Depression in America. It was mainly urban blight, where attractiveness of the city center to business is no longer there. So business move away. When you look at that curve, so the growth is really spontaneous. It starts when you have industry setting up, people moving from the rural areas to the city. A lot of investment is done in the city. So there's population growth, but also investment. So that process up to maturity, you can call it, it's spontaneous. It just happens on its own. But now turning that curve to face upwards again, which is urban renewal, it requires a lot of concerted effort by the three key stakeholders of the CBD. These are the property owners, local authority number one, and also the business users, call them tenants. So in America, these three parties came together, same as South Africa as well. But what really, the leader in this process is the city authorities, in this case, City of Harare. What do they have to do? When you look at the city center, there are two local plans that controls the usage of the CBD. The 40 grid, which is the upper side, we have local plan number 22. Downtown, we have local plan number 17. This local plan, they say every stand you have, you are allowed to go up 12 floors, you are allowed to do retail, etc., etc. The last review of these two pieces of legislation were done in 1996. When you look at the current needs of the urban area, 96 and now they've changed. So it is the city that has to use policy or urban law to review the local plan first, change the usages, align the prescribed uses to what the market is looking for. That way, it then incites investors, property owners like ourselves, to look at, say, charters, for example. What else can we do apart from offices? We are now allowed to do hotels, to do apartments, which were not permitted before. So that process, we have been engaging with City of Harare through as MASH, but also as Property Owners Association of Zimbabwe, to try and relook at all this. City of Harare is very much aware in terms of what we need to do. So your question to say, can it happen in Harare? Yes, it can happen. It's not spontaneous. It needs concerted effort. It needs a local planning authority who takes leadership, and the property owners support in terms of financing the researches, reviewing all these local plans. I think we have managed to find each other, but now is the work on the ground now to happen.
And Gibson, as we are coming to the end of the show, I want you to address the analyst and the investor maybe in a minute, especially they are concerned that maybe the numbers, the US dollar, the Zim dollar numbers won't really make much sense to them. What are other non-financial value drivers for March that you would want to showcase maybe in just a minute?
Okay, thank you very much for that. So I think moving away from the typical financial metrics is return on equity, etc. It's about occupants.
Okay.
So our business, we sell space. So our sales is occupants. When we have an occupancy level of 87% in this environment, you check the quality of our tenants and you feel like these are tenants who can pay their obligations, rentals, then the shareholders should be happy. It's about collections. It doesn't make sense to sell space and you're not able to collect the rentals. We closed the year at 92% in this environment, very compelling as well. So when you look at those two, and I think business is about creating cash flows.
Okay.
If we didn't have money, Kuda was not going to talk of those huge dividends.
Okay.
I hear you say they don't make sense. We are paying a US dollar 200,000. And apart from paying, he will tell you that we are financing projects with values of 3 million, 4 million, etc. And when you look at our gearing, it's very minimal.
Okay.
So what it means is the business is able to generate cash flow, pay dividend, but still be able to grow in this market. So I think when investors look at that, they should really take comfort in those very financial metrics.
So you have it, occupants, collections, cash flows, low gearing. If you want to think of much, that's some of the issues that you need to think of. If you find the financials very confusing. Otherwise, gentlemen, thank you very much for coming through. And it's been a very interesting discussion. We want to hear from you. So please send your comments on the comment section, and let's hear what you think about Mashonaland Holdings and investing in Zimbabwe. Otherwise, see you next time, and bye-bye for now.